In this video, we're going to look at the sale of merchandise. So in the last video, we looked at the purchase, and now we're flipping it to what happens when we actually go off to sell our merchandise. So we hope to address these questions here, and you could even think about them before we get into this. How are sales of merchandise recorded? How do the sellers of merchandise record freight charges? What happens when items are returned and they are damaged? And how are sales discounts treated? So again, I'd encourage you to pause and think about this. How would you actually do it if this was your business? Jumping right in, lesson 3, recording the sales of merchandise. And it's a little bit more complicated than the purchase, and there's a reason for it. It will require 2 entries, one to adjust the inventory account, and the second to show the actual sale, which will affect the owner's equity accounts. So, sales and freight. We take a look at this. The sale of goods requires 2 entries. One, which is a debit to accounts receivable or bank, because we made a sale, and it's either through an invoice or paid with cash, and some sort of credit to our sales, our owner's equity account. And the second entry is to debit the cost of goods sold, COGS, and the second is to credit the merchandise inventory. So this is the adjustment to the inventory. And here's our final little bit. Freight charges paid by the seller are expensed. All right, let's jump in right into a new example here. Journalize for Lenovo. In this case, Lenovo is making a sale of some goods. So September 20th, Best Buy purchases $4,000 worth of merchandise costing $3,000 with cash. And we've tried to simplify this. There will be 2 entries involved, and I'd encourage you to pause and see if you can figure this out on your own before you see the answer. 2 entries, September 20th. One will end up being the sale, so we'll have $4,000 going into a sales account, and we'll have cash, which will end up being cash or bank. So this one's being debited, which means our sales will be credited. There's our $4,000, but this has not changed or updated the inventory amount. But we do know that the cost of the inventory being sold here is $3,000. So we have to create this new account called cost of goods sold, which ends up being debited $3,000, and our inventory gets credited to reduce its balance by that amount. So that is our first entry, and that is pretty much as simple as it can get when it comes to selling goods to another customer. Now, we could also take these things and combine them into one compound entry, but for simplicity's sake and teaching's sake, it is good to just show you that these are broken up into 2 different entries. Both are fine to do if you're to do this on an assessment. What about returns? Well, we have this new account called Sales Returns and Allowances, and it's a contra account. So think about this. Remember, contra accounts end up being in the opposite side of where the normal balances are. Merchandise inventory is usually an asset which is then tracked on the debit side. So that means that sales returns and allowances is a credit account. It's a contra account. Damaged goods expense is an account if returned goods cannot be resold due to damages or defects. So there will be 2 situations coming up when we end up having returns. One will be returns that are okay to be resold, in which case we're just basically reversing our entries. And then there's the second one here where the damaged goods, well, they're not going to end up going back into inventory. We just end up writing them off as an expense. Jumping right into our second example, we are going to be journalizing some entries for Lenovo for returned goods. So Best Buy isn't happy with the laptop sold for $500, but they cost $300, and returns them September 24th. There are 2 situations in this case. The first situation, A, the laptops are okay and can be resold, or B, the laptops are damaged and cannot be sold. I'd encourage you to pause at this point and see if you can do this on your own. So let's just set this up. The very first entry will be the same no matter which situation occurs. We're going to have sales returns and allowances, which will be debited, and the bank ends up being credited $500. Apologize for that. That's because they end up being sold for $500 and they go back in. Now with situation A, the laptops are okay and can be resold. Well, this means that we end up putting those $300 back into inventory. And we have to also reverse the cost of goods sold. So merchandise goes up, which means we debit merchandise inventory, $300, and our cost of goods sold, which was our owner's equity account, goes back down by $300. Now we get into situation B. What if we can't resell those laptops? They're damaged and they're done. well, then we just end up expensing them. So instead of them going back into inventory, they just go right out the door. And so instead of this being merchandise inventory, it's an expense account. So we get to expense those damaged goods. So we move into this next one, discounts. Quantity discounts don't affect the entries. Sales discounts is an account to track discounts such as early payment discounts. So we go back to this idea of this 5/10 and N30, September 20th. Best Buy purchased $4,000 worth of merchandise costing $3,000 on account with terms 5/10, meaning 5% discount if it's paid within 10 days, N/30, and no returns are made. So here's the situation. In situation 1, Best Buy pays discount balance on September 25th, so that's within the 10 days. And situation 2, Best Buy pays the full balance on October 1st. I'd encourage you to pause the video at this point and see if you could do this on your own. So let's just recap. These goods are being purchased by Best Buy from Lenovo. We've already done the entries for the sale of those items, and now what we need to do is the payment entries. So we've got one entry, which is here, made early, and this is actually going to be more complicated. But what exactly is our discount going to be? Well, $4,000, 5% of 4,000 will end up being 200, and so that means that our bank will end up being debited 4,000 minus 200, and we have a discount or sales, some sort of discount, which is going to be 200, and our accounts receivable gets written off the books with $4,000. That's as a credit. Now, the second situation is that they end up having to pay it after this discount period, and there's no discount. That's actually pretty simple. And that's because we just do straight bank 4,000, and we get rid of the accounts receivable by crediting it 4,000. So situation 2, 4,000, 4,000. No need to worry about sales discounts in this case. All right, let's jump right into our next example, a very comprehensive one at that. This will try and go through almost every single thing you've learned in this lesson all in one short question. So September 23rd, let's read through this. $2,500 worth of merchandise costing $2,000 is purchased by Best Buy. So we're actually acting as though we are Lenovo making the sale to Best Buy with terms 2/10 and 30. Freight costs of $100 free on board destination are paid September 24th. On September 26th, unfortunately, $500 worth of merchandise is returned, which costs $400. $100 worth of that merchandise is damaged. Lenovo receives discounted payment September 29th. Wow, there's an awful lot going on. So I'd encourage you to pause it at this point and see if you can work through this on your own. I suggest scaffolding this into each little journal entry transaction so you don't feel overwhelmed. Let's start with the first one. September 23rd, $2,500 worth of merchandise is sold on account to Best Buy. So right now, we know that this is an accounts receivable because of these terms being given. So we're going to be debiting $2,500 to our accounts receivable, and we're going to credit our sales account. So let's start with that. All right, there's our first entry, but now we need to update our inventory. So we've sold $2,000 worth of our inventory, which means our merchandise inventory will go down. It's going to be credited, and we need to debit something, and that something is cost of goods sold. Now we move on to this next little part. Freight costs of $100 free on board destination are paid September 24th. Now we notice that this is destination, which means Lenovo, being the seller, is responsible for this, and we have this new account called freight out or freight out expense. It will depend upon the company, but in this case we're calling it freight out, and in this case it's going to be $100. We're paying it, and it's going to be the bank account. So 100. And that takes care of this part here. So we're going to move on to the second part, which is about the returns. $500 worth of merchandise is returned, which costs $400. $100 worth of the merchandise is damaged. What we do know is that this $100 that is damaged will be written off as expense, which means that the other $300 will end up being put back in inventory, and we end up having our the other portion being our sales returns. So here's a little bit of a calculation related to the discount, but let's just pause here and see if you can finish this off on your own. Regardless of whatever's happening with that inventory and restocking it, we still have that $500 worth of merchandise being returned. that will not change. We saw that earlier on in this lesson. So we've got sales, returns, and allowances. We already know that that's the account that should be debited. And what exactly are we crediting? Well, it is $500 that Best Buy doesn't have to pay. So accounts receivable gets credited. So there's our first part here. Now, what about all this other stuff? Well, as we mentioned before, $100 is damage. That's a damaged goods expense or something along those lines, which is going to be 100, and that means that the other $300 goes back into merchandise. So there's our 400, and we have to make the adjustment because now this is goods that are coming back to us. It's not cost of goods sold, so we end up crediting our cost of goods sold by the $400. So we're essentially adjusting our inventory and cost of goods sold to say, hey, yeah, we didn't exactly sell this stuff. It came back to us, so it's back in inventory, or it was expensed off and no longer in inventory. Finally, we have this. We actually received payment, discounted payment September 29th, and that is within this 10 days. We could go 10 plus the 23 is 33. Yes, it is within it. So we get a 2% discount. 2% of what though? Well, if we just scroll back here, we know that we had $2,500 as a sale minus the $500 worth that we end up selling, which means $2,000 was sold, and so the 2% discount of $2,000 is $40. So we've got a sales discount of 40. The bank account plus that discount should be adding up to 2,000, and we're going to write off or get rid of our accounts receivable, which means our accounts receivable should be credited 2,000. So 2,000, 40 for our discount, and then here whatever's left over, in this case it'll be 1,960, because that will make sure that we have that balance in our credits and our debits coming from the 40 here. And we finish off with that. A very complex, comprehensive example. So if you found this challenging, that is okay. There was an awful lot going on here. Again, practice makes perfect. So as you guys go through this, these questions here are designed to reinforce your learning. If you have any questions, as always, I'm here to help you guys out. Feel free to ask questions, and enjoy until the next one.